Hello and welcome to this episode of Nothing Ventured with me, Ari Shah. Today, I was super excited to have with me in the studio Daniel Glazer. Daniel leads the US expansion group and the London office at the Silicon Valley headquartered law firm Wilson Sonsini. In today's episode, we talked about how in the last 10 years, there have only been 2 billion plus exits from M&A and only 3 listings in the US from the UK, even despite having 135 unicorns on the books. How we went from 2010, 100 million invested in the UK to 2021, 25 billion invested in tech. We talked about why and when you should think about launching in the US and incorporating in the US, as well as the sort of things you need to think about when engaging legal counsel when you are opening up in the United States. This is a great episode. Let's get to it. Hello and welcome to this episode of Nothing Ventured with me, Ari Shah. Today, I'm super excited to have with me in the studio Daniel Glazer. Daniel leads the US expansion group and the London office at the Silicon Valley headquartered law firm Wilson Sonsini. If you want to hear more about Wilson Sonsini and a bit about Daniel's background, please do check out our primer. But for the meantime, we're going to get straight into the podcast. Daniel, great to have you here with me today.
Great to be here. Thanks a lot.
Excellent. We're going to dive straight in. So when you and I first met, I'm thinking back, it's probably about 5 or 6 years ago now, we had a very long conversation around the fact that in the UK, founders tend to kind of get an accountant first, whereas in the US, you tend to have your first port of call as your law firm. Why is it so important to have good counsel in the US versus the UK?
Well, I mean, it's important to have good counsel on both sides of the Atlantic, but it's a different system, and there's sort of different incentives built in. And let me explain. So let's say if you and I were in the UK and we have a business dispute, right? And you and I go to court, and let's say that you win, then in the UK system, I pay most or all of your legal fees, and that creates a substantial disincentive for us to actually go to court and have a meaningful business dispute, right? Because nobody wants to go double or nothing with their legal fees. Right? But what that also does is create an environment where, let's say, it's very common in the U.S. for parties or for companies who are unhappy with each other to start sending nasty letters, right? Legal letters to each other. You don't see that as much in the U.K. Perhaps. Why? Because if I send you a nasty letter saying I'm gonna bring you to court and I'll see you in court, how credible is that, relatively speaking, given the relative lack of actual litigation in the UK, again, because of the disincentives with the fee shifting? So, in that environment where, there isn't as much of a threat of going to court, as much of a threat of maybe threatening to sue, legal tends to be, let's say, a little bit more reactive then, because you don't necessarily have that specter hanging over your head. Relative to the United States. In the United States, if you and I have a business dispute and we go to court and you win, you still pay all your legal fees, generally speaking, even though you won. And think about how that shifts the dynamic a bit, right? So, like, if you and I are negotiating a contract, right? And let's say that it's we just pull it off the internet because why not? It's easier that way. And then 6 months later, you and I have a falling out. Well, one of the things that I can do is go to my counsel and say, I want you to find any breach of contract claim I can find in that contract, which would be pretty easy given the ambiguity. We pulled it off the internet. And now maybe I'll threaten a claim against you. Now think about what your choices are, okay? You can go to court and beat me, but now you're out
100,000 in fees or whatever it might be.
Or maybe a lot more.
Yeah.
Right? Or you decide to settle on my terms because you don't want to pay that amount. You're between the proverbial rock and a hard place, right? So how do you avoid that? See, in the US, that potential for exposure leads to a substantial incentive to take problem avoidance legal advice. In other words, the way that you sort of work with outside counsel in the US, is, especially as a startup, is that they are, whether explicitly or implicitly, answering one question. How does the company achieve its business goals while managing risk? If you just focus on advising on purely business without understanding the legal implications, then you could end up in a position where you have that exposure between that rock and a hard place. But if you're just flagging risk in the United States, I mean, everything's a risk.
Yeah.
Right. So you always have to view it through the lens of how do you run a successful business while appropriately managing risk. And what it leads to is an environment where the lawyers tend to be very business minded, especially the ones who work with startups, because the company is trying to grow fast, break things, right? But if there's different ways to break things in a way that doesn't necessarily lead to legal risk, maybe that's the way to do it. But if you're a business person, you're much more attuned to the fact that you probably want to take advice from counsel as you're scaling the business so as to not unnecessarily find yourself slowed down by those exposure risks.
I mean, I think it's super interesting. There's a couple of kind of examples that I would give. I mean, I've been through the process here in the UK, and it is, I mean, frustratingly slow, right? And one of the negative consequences of the system, as you described it, is because not much stuff gets to court. It's very easy for people to vacillate and essentially, be bad actors and not kind of in good faith try and negotiate settlement. So that drags things out. Secondly, the court system is in a bit of disarray, I would say, in the UK. Certainly post-COVID, it seems that way. Because you don't have that urgency, to your point, of whether you're going to have to settle costs or not. It's much easier to kind of just kick the can down the road and see what happens, which is why I think disputes here in the UK probably take longer to resolve than they potentially do in the US. And the other thing that came out of what you were saying, certainly from me as I was listening, is like, if I think about kind of what CFOs do in general, like a lot of that is risk mitigation. They often are one of the first kind of commercial, financial, business-minded people in the business in the UK, and it feels like there's actually a huge crossover there, right? So essentially, what a CFO is doing in the business seems to be what a lawyer is doing at very early stage in a US firm, and I mean, I don't think there's anything wrong with either of those sort of scenarios, as it were. But it's why it's so essential that actually both work together pretty closely as well, right?
No, absolutely. But it is, let's say, a potentially unusual dynamic for a UK or European company going to the US. And it's one of the friction points that we often see is that in the States, the companies that are native to the US understand these dynamics, right? They understand, for example, that if you're a startup, as you build pretty quickly in your life cycle, you end up having basically 5 advisors around you. You have a law firm, you have a tax firm, you have a bank, you have a business insurance provider, and you have a payroll and benefits provider. And those are the advisors who deal with all the administrative and logistical complexity of the United States, right? It's 50 states. Each state has its own legal system, its own set of laws. Yep. Each state has its own tax system. As an accountant in the US once told me, there are 13,000 different taxing geographies in the United States. When you combine state and city, local, federal, you end up with 13,000. But the funny thing is that if you tell an American company that, they'll shrug and say, yeah, okay, that's what my accountant does, right? And that sort of reliance on delegating to that outside team who's working hand in hand with you to help scale the business, that's culturally normal, right, for U.S. businesses. That's not necessarily the way that it is as typical in the UK. I think the UK is probably a little bit more DIY. I mean, as an American coming into the UK, I find the UK to be very business friendly. It is a little bit easier here than it is with the U.S. You don't have that kind of 50-state overlay. But then when you go across to the U.S., it becomes a little bit uncomfortable. Like, well, hold on. I didn't realize that I have to rely on all these this sort of outside help. And I can certainly tell from working with many companies who do this is it feels a little bit awkward that that's not how they're used to running a business. And it does become a bit of a competitive advantage for American companies in terms of how quickly and aggressively they can move because they're used to working in that environment.
Yeah, I mean, I think that's super interesting. I think the other thing I would say is in the UK, there's probably like this, and it's, I mean, just thinking about it completely sort of off the cuff. If you think about sort of funding rounds in the US, a lot of that is because you have these additional costs you're going to have to lay out, right? You can't rely on doing zero on your own and kind of figuring out, as you say, pulling a contract off the internet. So you need to be set up for success in managing those back office risks. Whereas in the UK, you can get away with it, which means when you go to the US, oh, sugar, all of a sudden I've got like, I don't know, whatever, an extra 30 grand a month to pay. Like, where's that going to come from, right?
Yeah, I mean, that's a great observation. I mean, we often get the question, like, why are the rounds so large in the United States? And it's a couple things, right? It's number one, the cost of scaling the business on average in the U.S. is higher, and it's everything, right? The salaries are higher, the marketing costs are higher. I mean, it's just more expensive in the United States. But the upside is higher too, right? And the upside that the VCs are looking for in the U.S. is substantial. So there is a willingness in the U.S. on average to provide those large rounds to companies for kind of two reasons. The first, as you said, because it costs maybe a little bit more to run a successful U.S. business, but also the desire to give the company enough money to really drop the hammer and win the market. Because if then you win the market, then the exit valuation is that much higher and everybody wins.
Yeah, and we're going to talk about that a little bit further on, both in terms of kind of the VC funding as well as the exit kind of dynamics. But from your perspective, what are the trigger points for a UK firm looking to expand into the US? And when should they consider getting the right structure in place? Yeah. And whether that should be, a topco flip to the US, which, we've talked about previously between ourselves as well, a subsidiary or something else altogether. I mean, what are the triggers, and then what is most appropriate at what time?
Sure. So the bright red line of when you need to set up a proper structure in the U.S. typically is when you're hiring your first U.S. employees. There's a lot of things that you can do with respect to the U.S. as a UK company that you don't need any particular structure for. For example, selling in remotely to U.S. companies, unless you're selling into certain U.S. government entities or the military, you generally can sell into the U.S. Straight through your UK company directly. Hiring contractors in the U.S. You don't need an entity to hire contractors in the U.S. Hiring employees through an employer of record service. You don't need to create a structure to do that, right? Going to meetings, generally raising money, attending conferences, negotiating contracts, all that stuff you can go to the U.S. You don't necessarily need a visa for, and you don't need a company. But the bright red line of when you would want to create the company is when you're hiring your own employees. In other words, not through an employer of record, not through a contractor arrangement, but your own proper employees. Because basically for three reasons: tax, liability, employment law. In other words, you don't want to create a taxable presence of your UK company in the US. You don't want to end up with a direct line of liability to the deep pockets of the UK company from the US, and you don't want the ambiguity of UK employment rules and US employment rules with a UK employer and a US employee, in short, right? But it's going to be a subsidiary, right? Yeah. As I often say, our advice on this is a tweetable piece of advice, which is that the decision to create a U.S. subsidiary is operational and commercial driven. The decision to create a U.S. parent company is solely investor driven. Yeah. Right. In other words, to the extent that you need a U.S. company, pretty much everything that you want to do in the U.S. you can do through a U.S. sub. Right. Typically, by the way, wholly owned Delaware corporation, owned by the UK company, with the exception of, and this is the Delaware flip point that you alluded to, if you are raising typically from early stage U.S. investors, most often seed, sometimes A, almost never B anymore. If you're raising from certain early stage U.S. investors, some of those U.S. investors will not pull the trigger and invest in the company unless it agrees to become a Delaware parent company, right? And that's the so-called Delaware flip. In other words, a share-for-share exchange between the UK Limited and a new Delaware corporation that results in a Delaware parent company with a wholly owned UK subsidiary. By the way, why Delaware? The headline: Delaware reduces friction. You have to incorporate you incorporate a company in one of the 50 states in the U.S. There's no such thing as a national company, right? We all use it with shorthand, U.S. company, and that's fine. But technically, it's a company that's incorporated in one of the 50 states. And again, Delaware reduces friction. Long ago, it established itself as the go-to state for incorporation in the U.S.
I mean, the thing that strikes me, because you said it's typically kind of that early stage. If you're seeking early stage investment, that's where a top co flip might be required. But essentially, there is no real reason for that other than simplicity for the investor. Because to your point, if they don't require it at A or certainly at B, then it can't be that there is something that is stopping an investor from investing in a UK company. It's just friction, right? Or it's just, simplicity on their side, ease of reference. They're able to kind of navigate that sort of situation much easier than if it's a US company. So it doesn't seem like there is an actual any purpose to doing a US topco flip other than to satisfy investors, right?
So let's break that down a little
Sure.
bit, right? So first of all, I would say what we're seeing, especially post COVID, is if you're looking to raise a U.S.-led seed round, and when I say U.S.-led, I mean investors who are based in the States who do not have a London office.
Yep.
Okay. So what we're seeing is usually about 75 to 80% chance that VC at seed would require a flip in order to pull the trigger. By the time you get to Series A, it's down to about 20 to 25%. I mean, and that's what's dropped materially, I think, over the course of the pandemic, and actually as more and more investors not only got used to investing remotely but got comfortable with UK companies, is that at Series A, I would say pre-pandemic, I would have put that number at about 60 to 70% chance.
Okay, as high as that.
And it's down to about 20 to 25% now. Yeah. And we haven't seen a Series B or later UK limited company have to flip to take in money in a long time, right? So I mean, I'd put that at virtually zero. But at the early stage, to go to your point, look, to some extent, it's simply friction. It's simply that the companies are, from the U.S. investor standpoint, frankly, too fungible at that stage to go out and find UK counsel and understand what are my rights as an investor in a UK company, because again, Delaware reduces friction in the respect that US VCs know exactly what their rights and obligations are under Delaware law. And anytime they invest outside of Delaware, they have to go and try to figure it out. And the earlier you are and the more fungible you are, the less interested the US VC is going to be to do that. That is one consideration. However, there are a few other considerations. For example, there are certainly some US funds in their fund documents prohibit the fund from investing into companies based outside of the United States. Sure. And we always tell UK, European companies we work with, that's not negotiable, right? I mean, if the VC has that restriction contractually in their documents, then you as the company need to decide. Because
they'll only have been able to raise from the LPs based on having that restriction.
Right. Now, in fairness, that is not that common in the United States, but there are still certain funds that have that. Also, in fairness, there is some benefit, and I don't want to oversell this. I want to preface this, right? I don't want to oversell this. However, there is some moderate benefit when you are hiring U.S. employees to provide the options to those employees out of a Delaware parent company as opposed to a UK limited. In other words, it's a little bit more tax beneficial to the employee. On the other hand, I mean, I can't tell you the number of UK limited companies that we work with who very easily go out and hire in the U.S. and provide options to U.S. employees. To the extent that this becomes an issue, you just simply gross them up a little bit and provide them a little bit more in options. But I'll tell you the bottom line takeaway that we always tell companies on the Delaware flip, which is the following. At the end of the day, don't worry about it. Okay? Here's what I mean by that, right? Wait until you go out and start talking to U.S. investors. And if U.S. investors who you are interested in, start saying to you, you seem like a pretty interesting company, but I'm a little bit hesitant to invest in a UK limited company, then you say back to them, you say, great. If that's the last gating item for you, then we can talk about that, about flipping into Delaware, and we could build it into the term sheet.
Yeah.
Right? Because that protects both sides. If you build
so
it into the term sheet.
You only do the flip if the investment comes through rather than...
If you know that the money is going to come to fund the flip, and that protects both sides, protects the VC, and that they never have to deal with the limited, because the flip completes first, then the financing docs come in, and the money comes into the Inc., the corporation. But it also protects the company is that they don't commit to spending the money, and because it can be expensive, especially if you have SEIS or EIS, and you need to save that SEIS, EIS treatment for earlier stage investors, which, by the way, you can do. You can save it. But it's a complicated transaction. You don't commit to that unless you know that there's going to be an investment there waiting for you.
Yeah. No, look, I mean, that makes a huge amount of sense. I think you and I discussed, like, Y Combinator as an example will only invest in companies with a US topco because it's just easier, right? Like as in anyone that doesn't have a US topco, for them just becomes like, well, we just have no clue what we're going to do with this one, so we'll just leave it to the side. Right?
Well, I think it goes back to what I said before. I mean, the earlier stage the companies are, the more fungible, right? And it's hard to say when it's two founders, the proverbial two founders, a dog in a garage, right? That they're so
your Google roots are showing,
right. You're right. That they're so certain that they're going to be frankly worth it to go out and find Dutch counsel, French counsel,
Got
German right to deal with all of that, as opposed to saying, listen, it's going to be Delaware at this stage.
Yeah, no, I mean, it does make sense, but I guess, from my perspective, I guess my cautionary word to UK founders out there is, and sort of echoing what you said about getting it written into the term sheet is, it is a non-trivial exercise to set up in the US. And to your point, it isn't setting up in the US, it's setting up in a state, and then every state that you create a nexus in, there are additional filing requirements, et cetera, et cetera. So don't treat it as a simple kind of thing that, okay, yeah, we want to do some business in the US, we're just going to go and set up there. It is quite complex, complicated. There are costs associated. There's costs associated with setting up, and then there's ongoing kind of filing requirements at the federal, the state, the local level, and on it goes, right? So in fact, just talking about not quite that, but what are some of the primary challenges you see startups facing when they expand across the UK and Europe into the US, and what are the strategies that you think they can use to mitigate those risks?
So, I think one of the most common questions that we get is like, what do UK startups get wrong going to the US? And my typical response on that is timing, and it's the companies that go too quickly, and the companies that don't go quickly enough. And I'll break that down and explain what I mean. There are some companies that go to the US because they see the US. They see all the venture financing there. It seems like the streets are paved with VC gold, right? Clearly, there's massive market for consumption of technology and buying tech services and products. And how difficult could it be? I mean, we all speak some variation of English, right? And the U.S. and I'll tell you, as now a resident of the UK, it's amazing to me how close the U.S. often feels in terms of how it's reported in the media. Just the way that the entertainment industry in the U.S. is so present here. It's very easy to feel that the U.S. is pretty much the same.
Yeah, it's our neighbor.
It's our neighbor. Right. But from actually running a business there, it is just as different as if you decided to go expand into Germany, right, or expand it into China, right? The language, the seeming lack of language barrier, I think papers over a little bit, and it obscures some of the big differences. And what that means is that just because you've got product market fit in the UK doesn't mean you've got product market fit in the United States. And that's a common mistake. So we see companies sometimes say, we're going to go to the US because we're a successful tech company in the UK. And if we did it in the UK, the US is that much bigger. We just got to get over there. We got to plant the flag and we will go figure it out. Maybe you will go figure it out, but there is no reason necessarily to think that you've got product market fit or can eventually achieve product market fit there unless you are being pulled into the US by customer traction and user growth, right? Unless or sold remotely, that some sort of proof point going in. Otherwise, you're just taking a massive risk
and bet,
right? With a lot of money, because as I always say, the U.S. is an ROI play, right? It is more expensive to run a business there on average, but the upside is that much higher, and which means that you do it if you're confident that you can get ROI, and the more that you're being pulled in by those kind of proof points, the more likely you are to get ROI. But that's what I mean in sort of the first part of going too quickly is not proving out sufficiently that it's the right market for you before you spend the money to commit.
It's sort of assuming you've got a playbook here, it'll work over there, we're just going to launch, rather you almost have to have a separate playbook. Right?
That's right. That's right. So that's the first part of the, I think, the timing friction. The second part is not going quickly enough. And this one took us a few years to really recognize properly. And that is that we see lots of companies get a foothold in the United States, right? That they do get initial traction there, they hire their initial employees there. But then it's really hard to scale up massively in the United States, right? For a couple reasons. Number one, when American competitors start to realize that they've got a new competitor in their midst, they'll become aggressive, right? They'll start ramping up their own spending. They'll start going out and raising more money.
And they already have the relationships and
right. I mean, like they might. That's when you see them start to leverage the legal system a little bit, because remember, claims in the U.S. have settlement value, not because it's any necessarily a search for justice so much as that they're used as a business tool often, and that's not something that UK companies are used to. So I think the one part of that is the aggressiveness of American companies, if you really start to materially compete. But the other part of this that becomes difficult is sort of running a US business through a UK lens, right? That there's just certain ways that you operate a business here that are perfectly normal for the UK, but that don't really work well in the US. For example, your US salespeople probably will become the highest paid people in the entire organization. Yeah. And if you're on the ground in the US, that seems to make sense. If your CEO, your CFO are sitting here in the UK, and they're seeing the highest paid people in the organization be these American salespeople, like that just seems a little bit off, and that's a friction point that we often see, is that the US based team is constantly going back to the US team, the UK headquarter team, and saying we need this, we need this, we need this, and the UK team is looking at this saying, well, this isn't the way that we're used to running a business, yeah, right? And it's led us to believe that if the company long term really wants to try to become the market leader or the market winner in the United States, then eventually you really do need to put someone with senior management authority, maybe CEO authority, on the ground in the US. Now, I want to be very nuanced about that, because I hear a lot of commentary about, when you expand to the US, do you have to move the CEO? And the proper answer, in my opinion, is a little nuanced, which is, I mean, it's the dreaded, it depends. Right? Yeah. But I can tell you exactly.
But everything does depend always.
But I can tell you exactly what it depends on.
Right.
Right. Is that in our experience, if the company believes that the success or failure of the enterprise as a whole is tied to becoming a market winner, a market leader in the United States,
the presence in the US,
then you really need to have a senior decision maker who can turn the aircraft carrier of the whole enterprise, as it were, from the US. You need to have that person, that team on the ground in the US, because at that point, when you're saying we need to become a market leader in the United States, you are saying we need to win an away match. And if you're going to win an away match and if you're going to try to win an away match with all your best players at home, that's usually a bridge too far.
You're going to struggle, to say the least. Yeah, I think that's super, super interesting. I think it's something that a lot of founders maybe don't think about, maybe struggle with. I mean, often, they are open to it, but I guess one of the, I've having spoken to a couple of founders about this sort of thing in the past, you got to think about, is your partner willing to move with you? Do you have kids at school? All of these sort of considerations come into play. So they are not to be done lightly, and therefore you have to be very, very sure about what you're doing, why you're doing it, and what the implications are moving down the track. And again, it comes back to the whole risk mitigation kind of question before kind of really launching yourself in that direction. I wanted to wrap up talking about some of the nuances again between the UK and the US in terms of venture itself, right? So what are the main sort of differences you see in approach from VCs in the US versus the UK? And then the other kind of adjacent point, we touched on this a little bit, is what is the exit environment like here in the UK and why more broadly in Europe as well, right? Because there have been about 135 unicorns in the UK, but very, very few exits. Certainly, $1 billion plus exits so far. So where do you see that? How do you see that landscape? What is the role the New York Stock Exchange and other US exchanges, but US investors? How does that all work? Because at the moment, what we're seeing essentially is great businesses being built, but very, very sort of high barriers to exit for UK European companies.
So should we start maybe with on the venture side?
Yeah.
Right? Let's talk about some of the differences that we see. So I'll maybe sort of kick off with an anecdote, right? It was about 3 or 4 years, it must have been 4 years ago. I was on a trade mission with a group of UK companies called Brits by the Bay, right? And we met with a well-known Bay Area VC, okay? And the VC addressed the group, and he said something like the following. He said, "I want to explain to you Silicon Valley, Bay Area venture economics." And he said, our fund, like pretty much every fund in the Bay Area, is looking for companies that can return the fund or more, that have the ability to return the fund or more, not will return the fund or more. We can't promise that. We know that we can't get the company to promise that. There's no guarantee. But if there's no pathway to return the fund or more,
it's not interesting.
Then that's it, right?
Yeah.
The opportunity cost to deploy capital in that company is too great, because even if there's a certainty of a smaller exit, we're foregoing the possibility of the bigger exit, right? And he said, what we want to see is that if with our money and our expertise and our network combined with a big total addressable market and your team and a good business plan, that there's a possibility that we can make that magic happen and return the fund or more. And he said, think about the economics behind that and the math behind that. He said, we take 10% when we invest, typically, and we are at that time a $300 million fund. He said that means that we need to see a pathway to a $3 billion exit,
and that's assuming no dilution between now and so on. Yeah.
Right. And the room was like, wow. It's, and look, I think capital in the UK has diversified in terms of the style of capital significantly in the past few years. I think you've got the American funds in London, you've got the American style funds in London, but I think it is far more common in the United States to find VCs who are willing to place the big bet, knowing that they could have the big loss. For the possibility of the big upside.
Yeah.
Whereas I don't think that approach is as common. It exists here. I want to be very clear. It does exist in the UK, but it's not as common as it is in the United States.
I mean, if you were to listen to almost all of our guests, they would say that is exactly what their desire is. But I think I think there's also this big difference between the UK and the US in terms of kind of the investor persona, right? So a lot of the investors in the US are ex-operators or founders themselves. They've been through that track, and then they're recycling their own capital plus others. Whereas here in the UK, Europe, there's often much more kind of that money manager, traditional private equity style kind of approach, right?
Yeah, there have been surveys on that actually. A few years ago, Diversity VC ran a study on that. And I think what they found was that in the U.S. of the surveyed investors, something like 65% or so were former startup operators, had worked at startups, had founded startups. And with the investors surveyed in the U.K., I think it was 8%. Now, I think that's changed, a bit, right? But it's still directionally true, which is on average, U.S. VC investors, especially the early stage U.S. VC investors, tend to be startup folks, right, who have become finance folks, right? And it's not as common in the UK yet, in part because, and maybe this is a nice segue, in part because you haven't seen nearly as the large exits, right? Because that's how those startup founders, startup employees become investors. And because those are the stories over the generations of Silicon Valley and New York and the other major ecosystems in the U.S. is that the startup employees, got in relatively early, had a big exit, and then they become these prolific angel investors or prolific VCs. There haven't been that many stories like that yet in the UK and Europe. There are definitely some, but there aren't that many yet. And to get to that point, we need to start seeing exits at scale. And we definitely have not seen exits at scale yet in the UK and Europe.
Yeah. And from your perspective, how does that dynamic change? How do we actually ensure that we are seeing those exits? I mean, one of the conversations I have with a number of VCs all the time is, in part, it isn't actually a problem with the startups. It's a problem with the institutional and public sort of markets, the sort of investors you have in the public markets. They're kind of thinking around tech. In fact, I mentioned this, I think, on a recent podcast. I had a bit of a to and fro with, I think it was the Evening Standard's tech reporter. They had a list of top 50 tech founders or something in the UK. I can't remember exactly what it was, but within that, there were businesses that I would not consider technology. There were things like, Gymshark, which is, okay, yes, technology enabled in terms of how they sell, but it's a brand. So there seems to be this issue around, whether or not UK kind of institutional investors and those in the public markets actually quote unquote get tech and are willing to pay for growth rather than traditionally what they have been paying for, which is value, bank stocks, maybe some oil and gas, etc.
So look, I mean, the IPO market on both sides of the Atlantic at this point is a little bit little bit tricky, but I think we need to just keep in mind is that the the IPO outcome for any given venture-backed tech company is not that common, even in great times. Right? I mean, it's not necessarily the most likely outcome. I think the ratio of M&A outcomes to IPO outcomes is something like 5 to 6 to 1 or something like that. I mean, in terms of exit outcomes, the way we often think about it is that there's sort of three true outcomes, right, for a venture-backed tech company. Bankruptcy, so let's not talk too much about that one. M&A sale, whatever that looks like, and an IPO. And the reality of it is that of those two successful outcomes, the M&A one is far more prevalent. Yeah. And we have not seen that many large M&A sales yet in the UK. I mean, so we did some research on this, and I'm pretty confident that this is the case, that in the last 10 years there have only been for tech companies, putting aside biotech, pharma, but like proper venture-backed tech, there have only been 2 billion plus sales of venture-backed UK tech companies in the past 10 years.
Wow.
And we've got 135 or whatever the number is, unicorns, right? And then on top of that, in terms of let's say US listings, I think we talk to a lot of companies that think that say that a long-term goal is to list in the States. Yeah. But if you put aside SPACs, right, which and I think that market is in a different place than it was a few years ago. And if you put aside biotech and pharma, again, there's a different barrier to entry, a different bar to list on the NASDAQ as a biotech or pharma than there is for sort of classic venture-backed tech. In the last 10 years, there have only been 3 UK venture-backed tech companies listed in the United States, right? And I think that's pretty interesting, because the two most common exit outcomes that I hear from companies are, we want to sell, for $1 billion plus, or we want to go list in the US. Yeah. And in the last 10 years, that comprises 5 exits. So I think what we've been saying increasingly is that the opportunity is there, right? So my favorite statistic about London tech, in 2010, there was $100 million total invested into London tech companies, the year of the Tech City launch, right? 100 million total.
That seems
in 2010
ludicrous, but okay.
Right?
Yeah.
And then at the high water mark in 2021, there was 25 billion. Yeah. And that that scale is absolutely praiseworthy. The London became and is now the number 3, and sometimes tied for number 2, startup ecosystem globally. Silicon Valley number 1, and New York sometimes tied at number 2, number 3, right? But ultimately, the story hasn't been fully written yet. In other words, we've gotten almost to the end of the flywheel effect, or really got it going, but we haven't reached that last point, which is, how do you start getting exits at scale and turning that 25 billion in investment in 2021 into
hundreds of billions.
Exactly. Into 5x, 10x, a few years down the road. And that has to come, right? I mean, to create a sustainable ecosystem, that has to come. That's what leads the LPs to invest again in the next generation of funds. It's what leads, as we talked about before, the founders, the entrepreneurs, to become either repeat founders or to become investors. The earlier stage employees themselves have the money and the experience to go start their own companies. This is how generation after generation of that so-called flywheel effect, how the valley became the valley. And all of that is here in London. The recipe is here, but we haven't yet hit the exit point at scale where that can really start flowing.
I think that's a really positive note to kind of wrap up the podcast. And I think what I would add to that is, and you sort of alluded to that, the reality is that actually, in terms of an ecosystem, the UK is probably 20, 30 years behind where the Valley essentially started. If you think about the Valley from the kind of, late 50s, early 60s, the Trader Estate, et cetera, it's had a lot more time to incubate and grow and have those exits come over time. Whereas the UK, I was talking to someone who sort of said, from their perspective, really only since the early 2000s has the UK sort of tech scene started growing. And to your point, 100 million in 2010 shows you how small it was at that time. Daniel, I've got to say, it's been absolutely wonderful having you here in the studio with me today. Thank you so much for joining me. For our listeners, where's the best place for them to find you online? Are you on LinkedIn? Are you on Twitter? Where can they find you?
I'm on LinkedIn, I'm on Twitter, and you can always find me on the website, wsgr.com.
Amazing. Daniel, thank you so much for joining me here today.
Thank you.